the reinsurance sector rating outlook is negative. We've been negative for about a year and a half at this point in time. And the concern is that, and these concerns aren't necessarily new, but the concerns are that rates have been declining for several years. There's broader terms and conditions as well. We still have the low investment yield environment. We have favorable loss reserve development, which, while it does, benefit the P&L or the income statement at this point in time, it can't last forever per se. And then finally you have convergence capital as well, which is just placing a lot of pressure on the sector as well. Alternative capital makes up 20% of the dedicated capacity to the reinsurance space. Numbers float somewhere between 55 and maybe 65 billion of alternative capital. And I think at this point in time, given where we are and knowing a little bit of the history, I think most market observers or market participants do feel that it's a structural shift, that we're not going to return to days when it's just traditional companies and traditional balance sheets and alternative capital goes off and moves on to their next investment, so to speak. The broader view is that this alternative capital is here to stay. They like the reinsurance sector as a diversifying asset class, if you will, in their broader portfolio. And so with that said, they're committed to the space to a certain extent. I mean, that's not to say that there might not be some entries and exits, over time for different reasons. But at that 20% number that we're at today, it's certainly likely to grow. The trend has been for alternative capital to grow every year, and we do see that continuing. Over the last few months, we've seen M&A. That flurry is sort of hasn't been as exciting, if you will. But going into 2016, I believe there's still companies that are trying to jockey for position, and M&A might be part of that strategy in order to get companies where they might want to be. And so there could very well be more M&A on the table.
The outlook for the life reinsurance segment is stable, and this is characterized by a number of very large organizations with good operating performance, strong market positions, and favorable capitalization. The global reinsurance outlook is negative, but global re includes a large number of companies that operate more in just the property casualty space and not representative of books of business that include those large life companies. The largest global re companies have nice diversified books of business, including those life franchises in the United States that gives them some stability. If they have a catastrophe, they have another book of business to kind of smooth out the earnings impact. So we feel that just looking at the life segment, it provides a lot of stability to those global players. And also, there are life players that are not associated with international parents. And those companies, such as Reinsurance Group of America, also have a very strong franchise and have operated with very favorable results for the long term. Some of the headwinds include they are subject to the growth rate of the domestic market, particularly life insurance, which has been sluggish for years. It's always been a challenge to grow the more creditworthy whole life product, which is where there's a lot of value even for reinsurers to take those risks on. A profitable book of business, very stable. Some reinsurers that are not in the global space already because of their parent actually are expanding in Asia and other emerging markets for growth, so they're not completely dependent on the U.S. market. The other headwind is what we call cession rates. That's the amount of business that's presented to the marketplace. If you go back 6, 7, 8 years now, those rates were up in the 60% range. They're down in the low 20s. That's a very big shift. So that has taken some business away from the reinsurers. And the other headwind that we see is the extended low interest rate environment, of course, pressures yields, so they need to make sure that their underwriting is the primary profit driver. And mortality does fluctuate. Some companies do report some weaker quarters, but we feel that over the longer term, mortality and pricing are aligned, and we expect those companies to perform favorably over the long term.
We'd like to thank AM Best for their contribution to our program. If you'd like to see more of the First Monday series, visit the AM Best website.